Hello.
Hi, good morning, Becca.
Good morning. Hi, Professor Lori.
Hi, Beck. How are you?
Okay.
That's
Still really behind and trying to catch up.
okay. Good. I'm looking to see something. I wanted to try something with you guys today, but I gotta look. Oh, darn. Let's see. The other day I was on a meeting with my colleagues from Penn State, and they were actually able to do like a poll, meaning like I pose a question and you guys anonymously answer it. And I thought I would be able to do that. Well, it was within Zoom. So I've got to figure out how to do that because I want to do that on Wednesday with you guys. But for now, we're in our last week. This is it. Well, for teaching for me. Let's give everybody a few minutes. I'm gonna unrecord. All right, I'm going to get started back into class. Let me get back into my Word and share this. Could you guys hear me okay?
No.
Can't hear me?
Well, I can hear you, but I don't see the Word document.
Oh, okay. Just as long as you could hear me. Okay, here comes the word. Now do you see it, Kels?
Yeah, I do.
Awesome. So everybody should see it now. Okay. So we are going to get back into chapter 17. We're talking about the ratios. We looked at the first few liquidity and efficiency ratios. And just to review, let me make sure I'm recording. Let me close my door here. He decided to cut the grass. My son's doing his chores, then is cutting the grass. So if you hear the lawnmower. So we're looking at the liquidity ratios here. We looked at current ratio. Remember, these ratios are telling us how well the company can pay short-term liabilities, current liabilities. So the current ratio looks at all the current assets the company has compared to the current liabilities. And that tells us, again, for every dollar in current liabilities, the company has this much. So whatever the result is of your calculation in current assets. Then we take out some of the current assets and say, what kind of liquid assets are there? Financially liquid, those that are going to be converted to cash quickly. How much do we have of those to pay a dollar of current liabilities? Then we looked at the accounts receivable turn. We said, okay, this calculates how many times a year we collect on our accounts receivables. And then we changed that, or we went further and said, let's make that the number of days it takes us to collect our accounts receivables. And we call that day sales uncollected. So when you get into the accounts receivable ratios, now we're measuring how efficient we are, how well we use our assets or manage them. Are there any questions on those? Okay, so today we might have an abbreviated class today. We're going to look at the rest of the efficiency ratios and the solvencies. And I think we'll end class there, and then we'll pick up and talk about the rest of these on Wednesday, and we'll be good. So the next efficiency ratio, kind of doing the same thing as we did with accounts receivables, but we're doing it for inventory, which is another major asset that we need to manage well, because inventory sitting at our store not being sold is doing nothing. And an asset not earning money is very inefficient. So we want to sell it to make that gross profit, convert it to cash, buy more inventory, and the cycle keeps going. So our next ratio is inventory turnover. So just like we had accounts receivable turnover, inventory turnover. And that's calculated by taking the cost, so let's make this an equal sign, cost of goods sold for the year divided by the average inventory amount for that year. Now remember, when we're calculating averages, we take beginning inventory plus ending inventory divided by 2. So I'm going to go back to Apple's income statement and balance sheet we were using. On pages 619 is the balance sheet and 620 is the income statement. Now, their cost of goods sold, they call cost of sales. So they just use a little bit of a different term than goods sold. But when you see cost of sales, that's the same thing. So we're going to calculate this by taking that cost of sales amount, which was 141.48, and then divide that by now average inventory. So we'll go back to page 619. The inventory for the beginning of the year we're looking at is last year's ending balance. So 2,132. Now add the ending inventory balance of 4,855 divided by 2. Let me grab my calculator here. 2132 plus the 4855, and we divide it by 2. So I get 3,494. I just rounded it. So if I take the 3,494 and divide that into 141.048, I get 40.36. Let's see what your book does. Normally, what we say is, okay, round that. You could round that up, or you could leave it at its current. They rounded it to 2 decimal places in your book. So you can leave it at 40.36, 40, 40.4. That 0.36 is immaterial. What does it tell us? Just like accounts receivable turnover tells us how many times during the year we collect on accounts receivable, inventory turnover tells us the same thing, but related to inventory. So really you can look at this ratio from 2 perspectives. You can say it's how many times on average the company must replace inventory during the year. So Apple had to replace their inventory 40 times. Or 40.4 times during the year. If they had to replace their inventory 40.4 times during the year, so now this is the other perspective, or we could say it's how many times the company sells out of inventory on average during the year. Because if you have to replace it, that means you sold that inventory. So on average, so this isn't every single item that Apple sells, but on average, they have to replace their entire inventory 40 times a year. Some inventory items may be replaced more often, some more slowly. We're looking at inventory as a whole though. And that's what all companies in our industry do. So I think they give us an average for Apple here. Let me see. Or for the competitor. Let me see. They tell us in the book, Samsung, which is one of Apple's competitors, is 6. Google, 90. Okay, so these are two competitors and how vastly different. But if we average just Samsung, 6, plus Google, 90, and then divided by 2, we'd get 48. So maybe from those two, we could say the industry average is 48. There's this 40. Okay, that's the key though. You have to compare it to your competitors in your industry because we're all going to sell our inventory differently in different industries. So if the industry average is 48, then we aren't selling, maybe we're close, but we're not selling as quickly as our peers do on average. Are there any questions on that? What do? We look to see how we can better manage our inventory. Why isn't it selling as quickly? Do we have to do more advertising? Do we have to bring the price down? What's happening? Now, just like we have days sales uncollected to determine the number of days it takes us to collect our money, we also have days sales in inventory. Now, days sales in inventory is measured by taking ending inventory at the end of the year divided by cost of goods sold. So that's your first part of your computation. We'll put that in parentheses so that you know you do that first. That result you multiply by 365 days. So our numbers here, our ending inventory was 4,855. Let me just double check that. Yep. Our cost of goods sold, 141,048. So do that computation first. 4,855 divided by 141,048. And it's about 0.03442. Multiply that by 365 days. Get 12.56. So this measures how many days on average it takes the company to sell its inventory from the day of purchase. So from the date they purchase it to the day they sell it, it takes about 13 days. So I like when we convert the information into days because, wow, it only takes 13 days to roll over basically our inventory. Now, is that good or bad? Well, it all depends. Now, in your book, they tell us Samsung, it takes, I think it does anyway. Samsung, it takes 70.5 days. Google, 6. So we're in between. We're closer to Google. And we could always average that. 70 plus 6, 2 companies divided by 2. So on average, it takes about 38 days for our competition to sell their inventory. We take 13. Pretty good then. So it's all about looking at our competition. Are there any questions on that? So the quicker we're selling out our inventory, the more money we're making, the better we're managing it. Our final efficiency ratio is called, another turnover, total asset turnover. Now that's found by taking net sales. Now remember, why do we use net sales? Because that's the money we're creating with our assets. We're using our assets, all of them, to do what? Make sales. Divide that by then the average total asset amount. So how much did we buy in assets on average? Let's see how much in sales we created from those assets. So we're going to go back to our income statement. Our total sales are 229, 234. Divide that by, go back to your balance sheet on page 619, total assets, all assets, not just current, all assets. The beginning is 321 because we're averaging, right? We have 321, 686 plus ending 375, 319 divided by 2. So average the total assets. 321, 686 plus 375, 319 divided by 2. So my average total assets are 348,503. I rounded. So I'll take the 229, 234 divided by my average assets of 348,503. And I get 0.6577. 0.6577. So it's measuring on a dollar. So for every dollar of assets, the company generates points, you could say 66 cents in sales. Now, Google, their asset turnover is 0.61. Samsung, 0.85. So it looks like we're in the ballpark with our competitors. How will we use our assets to generate sales? So for every dollar of assets, the company generates 66 cents in sales. Are there any questions on that? So remember, we just don't sit here and go, oh, 0.66, I don't think that's good. We should do at least $1. No, it depends on your industry. Google nor Samsung does at least $1. Oh, wait a second, I'm sorry. That's right, there's the industry average underneath, 1.1. Ooh, and none of us are doing as good as the industry. You look on page 624 in the red, in the margins, I just noticed it myself. Sometimes they do give us an industry average. So for instance, up here, days sales and inventory, this one right here, the industry that Apple operates in is 35 days. So Apple's doing very good with selling their inventory because everybody else in their industry, it takes 35 days from the day of purchase to sell it. Down here, the industry is able to make $1.10 in sales for every dollar in assets. Apple's only making 66 cents. I don't know why. Something that needs to be investigated. So they don't utilize their assets. They're not using them as effectively and efficiently to generate sales as their competition, the industry on average. Again, these are measuring liquidity, how well we can pay our current liabilities, and efficiency, how well we use our assets and manage them. Are there any questions? Clancy wants to say hello. No, go come here and say hello. Come here, say hello. You gotta look in the camera right here. Sorry, okay. All right. Off to our next ones then. So that was our first set. Now we're gonna look at solvency. Now, solvency ratios are going to tell us how well the company can pay long-term liabilities and also liabilities overall. Okay, so we're going to focus on more long-term liabilities, but you'll also see we do look at all liabilities when we're determining these amounts. I don't have my favorite one here. Yes, they do. Okay. The very first one we're going to look at, this is my favorite one, is the debt ratio. I just find favorites because I just think they're so much easier to understand. There's certain ones that are more complex to understand. And plus, I use them a lot in my day. The debt ratio is found by taking total liabilities of the company and dividing them by total assets. And if you remember back to vertical analysis, you actually do this in vertical analysis. Now, we're not focused on current or long-term only, it's all debt. Go back to our balance sheet. Total liabilities for Apple is 241, 272. Divide that by all assets, 375, 319. Divided by 375, 319, and I'm getting 0.64. So 64, I'm going to change that to a decimal, 64.28%. Now, you can look at this from a couple different perspectives. The first is straight out with the percentage, 64.28% of assets still, or let's put it this way. Let's do it this way. The company owes, hold on a second. Let's put the word still in. Still owes on 64.28% of its assets. So it still has liabilities attached to it. It's like saying you own a car and you still have to pay off 64.28% of it. Now, one thing I have to remember, and we'll be getting into this more, and it takes us back to Accounting 1, one of our very first classes. Remember those days? Assets equals liabilities plus equity, that accounting equation. Very simple. Think about, now that we really understand more about liabilities and equity, assets, the things we own, are really attained or purchased from one of two groups of individuals. Creditors, who are the liabilities of the company, and owners, which is the equity of the company. And if you say, well, you could buy assets with cash. Yeah, but whose cash? Okay, so all of the company's assets were purchased with either creditors' money and we still owe it back to them, or owners' money. Okay, two groups. What we're measuring here is how much do we owe to these cats? Of all the assets we own, we still owe on 64.28% of them. Now, that might be okay. Let's go see what our industry does. I don't know if they have that in here. That's the debt to equity ratio. Give me one sec. Oh, okay. Nope, they're not telling me here. Oh, industry average is 35%. So we are much higher. We owe on a lot more of our assets than other companies in our industry. So that's not normal. And maybe a bank situation, somebody who's looking to loan us money may say, that's too high. We're not comfortable that you'll be able to pay off another loan if we loan you more money. So this is how we look at this ratio. So just a standard is the more of your assets that are financed with owner's money, the better off you are. So the lower this number or the less you owe to creditors, the better off the company would be to pay off their long-term debt. Two things creditors require that owners don't. Creditors require their money back, repayment on a schedule. Owners don't require that. And the other thing they require is interest. Whoops, normally on long-term debt, sorry, that should be a number 2, is interest. So you have to pay back the money you borrowed on a schedule and interest. So that's why we like to see more of the assets financed with owners' money, but sometimes that's not possible. So then we look to the industry average and go, well, what's normal? And Apple's doing something there that is causing their long-term debt to be higher than the other, their comrades in the industry they operate in. So that could be an indication that they're not as well able to pay off their long-term debt as maybe others in their industry. Are there any questions on that? Okay. The next one, I'm going to flop to another one. It's called the times interest earned. Now, the first ratio we looked at, you have to remember total liabilities is only the principal or the amount borrowed. It's not the interest portion. So now we're seeing, okay, principal wise, can they pay off the principal? The times interest earned is looking to see how well you could pay your interest. So times interest earned is found, it's a big long numerator, income before interest expense and income tax expense. So that's your numerator, divided by interest expense. Be careful here, it's interest expense. So if it says interest revenue on your income statement, that's not what we're talking about here. We're talking about the amount of interest you're going to have to pay because you have long-term debt. I'm going to go on back. We're getting all this information off of our income statement. So if you look, we have net income. Does it give us interest expense here? Ooh, it doesn't on the income statement. You would have this on yours. Where are they getting that from? Oh, okay, I see. we would be using provision for income taxes, interest expense. They must have given us interest expense somewhere here for Apple that I'm just not seeing. Did they tell us it? Bear with me 1 second. It must be in chapter 11. They must have used, let's take a look back. Let's see if I can find this so we can find out where they came up with the number in the book. Give me a sec. Chapter 11. Should have got this done. All right. Yeah, they're using Apple here somewhere. You find their income statement. Stupid what they did there. There we go. Okay. The explanation is on page 410, but I thought maybe they would give us some information about Apple's interest expense. But you would need to see that. And I'm not seeing where they came up with the 23. I'm on page 625, by the way. If you look at Apple's income statement, their net income, it gives their provision for income taxes. It gives their other income net. Now, that other income net would include interest expense and other income items. And I don't see the breakdown of that anywhere. So we're just going to take it. You would need to know that. And in a homework problem, you would have that. It would tell you the amount of interest expense. Apple's, in this case, is going to be $2,323. So what does that mean for us? We're going to take income of $48,351. So their net income off the income statement. Make sure you see that. Since it says, no, we don't want that. We want the income before any interest expense and any income taxes are deducted. Well, those two items were deducted to get to the $48,351. We don't want them to be deducted, so add them back. So $2,323 is the amount of interest expense that needs to be added back. And you can see the income tax, $15,738 of the income tax expense needs to be added back. Now, why do we add these things back? Because we want to know how much did we make this year, basically, to pay interest expense. That's where the company gets their money to pay interest from the earnings. They can't borrow it from the owners or go out and get a loan to pay interest. Who's going to loan you to pay the interest? If you can't pay the interest on your loans from the earnings you make this year, why do we want to loan you any more money? So we look for all the earnings that the company made before we paid income tax and before we even paid interest once, and then divide that by the total amount of interest expense. So we take $48,351 plus $23,23 plus $15,738. So now our numerator will be, oh, come on, you're supposed to enter, $66,412. So that's our earnings before interest expense and income taxes. Now divide that by the amount of interest expense we are required to pay for the year, $66,412. And we get 28.59 times. Dylan, could you let him out? 28.59 times. That's what they get in the book. Well, what does it mean? It's the number of times the company can pay interest expense with their current earnings. Now, are they going to pay the interest expense 29 times? No. But the standard kind of is, it should be at least once, and the more times the company can pay their interest with their earnings, the more likely they will. So they're in a better position to pay interest. Now, Google, they don't have an industry average here. Google's is 251 times. So that tells me they have a lot of earnings compared to the amount of interest they have to pay. Samsung is 87 times. So we're in a not as a good position, Apple is, and as our competitors are. And we kind of knew that from this debt ratio. We have more debt at Apple than the industry does. So that will cause our times interest earned ratio probably not to be at the same standard as our industry. So they're in a worse position to pay long-term debt. They're not as solvent. More of their assets are financed with liabilities. So that means they're going to have more interest expense. Now, that's not the, as a banker, I might say, well, they can pay their interest 30 times. I'm okay with that. All right. So it all depends on the perspective of the decision maker. That's what it's telling. Are there any questions on that? All right. I think we got one or two more here. Insolvency. Oh, the equity ratio. So let's first do the debt to equity ratio. Debt to equity ratio. Is our next ratio. And that's found by taking total debt or liabilities, let's do it that way. And instead of dividing it by total assets, we divide it by total equity. So back to our balance sheet. And our total debt for 2000, for whatever year, the current year it says, is 241,272. Whoops. Total equity, be careful, 134. Don't take the total liabilities and stockholders' equity. Take 134,047. 241, 272 divided by 134,047, and we get 1.8. Okay, and that's showing us basically for every $1 in equity, there is $1.80 in liabilities. So again, it's measuring how we finance the company. So there's a greater amount of liabilities financing the company than there is equity. So it's looking at that ratio of how much debt is there to equity. $1 of equity, $1.80 of liabilities. Now, I don't know if they have a average here. Let's see, equity ratio. Yes, they do. The industries is 0.6. Now, you've seen from the first two ratios we did that Apple has that higher amount of debt. So they're naturally going to be not doing as well. So a higher ratio here is not good. So the industry, for every dollar in equity, they only have 60 cents in liabilities. So they finance more of their company with equity. And we said why that's good compared to debt. Here it's opposite. $1.80 in liabilities, $1 in equity. So they're in a weaker position when it comes to solvency because of that high rate of liability. The final, any questions? All right. The final ratio in solvency measures just equity, the equity ratio. And here we're taking total equity divided by total assets. And there's another way you can get the equity ratio. Take 1 minus the debt ratio. It would give you the same answer. And I'll show you that. So here we're looking at what percentage of our assets are financed with equity. So going back to our balance sheet, that's where we're focused. We would take now total equity of 134,047 divided by total assets of 375,319. And we get 35.7%. Now, if you come back up here, I'm a little off. I'm off by 0.02. Let's do it this way. 35.72%. Let's go 2. Now I said, or you can also take 1 minus your debt ratio. The debt ratio we did up here, 64.28. It'll give you the same amount. 1 minus 60.64. Come on. Hold on. 1 minus 0.6428, 35.72%. Okay, so either way, because assets are only being financed with debt or equity. So if 64.38% of our assets are being financed with debt, then it has to be the other 35.72% are financed with equity. And on page 624, they tell us the norm for the industry at the bottom of page 624 is 65%. So we're kind of backwards here when it comes to our industry. 65% of the assets are usually financed with equity, 35% with debt. That's the norm for the industry, but we're opposite at Apple for whatever reason. Again, it's just showing us how well we can pay our liabilities with, because of, how well we can pay them due to the fact how much of our assets are financed with equity or with debt versus how much are financed with equity and how well we can pay our interest. So these ratios define that for decision makers. And comparing ourselves to the past and our industry will help us identify that. Now we're in a weaker position here, but is the company doing anything to change that? Maybe this is an anomaly for this year. Maybe they had to take on a lot of debt this year to finance a huge project. It's going to have a high, income come out of it that will be able to pay off this debt quickly. So we need to investigate that further. This is making the identification of issues, they're bringing them to our attention. Kind of like when the doctor checks out that blood pressure and says, whoa, you're a little different than the average. Let's find out why, maybe do some more tests. maybe put you on some medication, try some things to change that. Any questions? Okay, guys. Well, I think I'm going to stop there for today. And then on Wednesday, we're going to pick up with the profitability ratios and the market prospects. And then we will be finished with discussing analysis. Okay, on Friday, we're going to wrap up talking about our couple homework problems, or I think we have 2 more to go through, and we'll be done with chapter 17. Do I have anybody have anything before we stop for today? Okay, well, have a good rest of your day, and I will see you all on Wednesday.
Thanks.